Okay guys, what's going on? So I just want to give everyone a moment to catch up, have everyone log on. If you are just logging on right now or if you're just entering, go ahead and introduce yourself and to give probably about 1 to 2 minutes before we actually get into the live stream. And if you could hear me, please respond. I just want to make sure that the sound is coming through nice and clear. Can everybody hear me? Okay guys, so I want to start on time. I believe in being punctual. So what we're going to be doing in this video is talking about trading with margin and leverage. So primarily we're talking about leverage exchange or derivatives exchange Bybit. So for the sake of this live stream, we will be referring to the Bybit testnet platform that you're currently viewing. So this is Bybit's testnet. If you don't, if you're not currently a member of Bybit, feel free to use our link below. All right, they do offer a testnet, which is basically the simulated form of trading. So in this video, or rather first let me introduce myself. My name is Ryan, aka Cantor & Clark, and I am partners with Josh Roots, and we have created BlockRoots. Josh Rager. So we are partners together. We created BlockRoots, and we hope to be your knowledge source for the crypto market. We are heavy in the technicals, primarily focused on trading, but we do talk about investing. All right, we do talk about fundamentals and so forth. But we have a trading workshop coming up on November 11th. If you're not currently a member of BlockRoots, I believe that we offer a platform that not only has a tremendous community of peers that are all contributing constantly, but I think we go over the material we go over rather is unlikely found anywhere else in the environment right now. So my background, I started as my trading career began as an equities derivatives trader. Then I got into trading energies or crude primarily, and now I am in a monogamous relationship with Bitcoin. So primarily Delta One, so I'm mostly trading on the futures platform, mostly trading, but I am pretty much agnostic in regards to what direction the price travels. For the most part, I have my spot allocation, and I am primarily just trying to take advantage of moves north or south, regardless of whether or not we hit an all-time high within the next year, 2 years, 3 years. It's not really something that sits in my thought process too often. So primarily I trade order flow. So what I'm always trying to do is identify who's in control, who's offsides, or who potentially is offsides, where they might potentially be offsides. A heavy focus on the auctioning environment, looking at things like cumulative volume delta, aggressive order flow versus passive order flow, price and volume, and so forth. So if you're not a member of BlockRoots right now, that is what we are going to be heavily focused on in the trading workshop on November 11th. This has been one of the key reasons why I was so keen on recent near-term tops and bottoms. Okay, being able to identify this shift and what I like to refer to as to identify the heavier hand. So if you're not currently a member, sign up. We're probably one of the most affordable platforms considering the experience level that I think that we bring. So we're going to be talking about Bybit. Okay, I'm going to be talking obviously about what you're looking at right now, the interface. Okay, some of the things you're going to be observing when you log onto the platform. Okay, at any time if you have any questions, feel free to leave them up. So we're going to be talking about how to use leverage. What is leverage used for? Okay. Margin and leverage, right? So we talk about margin and leverage. Margin is primarily used when we think of margin as what we're using on a spot exchange. So borrowing to buy spot. So for this live stream, we're talking about a derivative. So it's based on the underlying spot, okay, based on Bitcoin, but it is a derivative. So, when you're talking about margin or when you're using margin, if you're on a spot exchange, margin, you're going to be paying higher interest, okay, to take out a position. You're going to have less access to the actual leverage you're able to employ. So I will, say as a caveat that leverage is what is the ultimate demise of many new traders, okay, and experienced traders, over leveraging. But on the margin exchanges, you're pretty much limited to, three times leverage for the most part. Whereas on the futures exchanges, okay, or on the derivatives platforms, you're able to go up to 100 times, unless you're on Binance and you want to really throw your account away as fast as possible, and you could do it 125 times. So we're also going to be talking about what is everyone's major concern when entering one of these derivative platforms, and that is the concept of synthetic USD. So pretty much, without getting too heavy into convexity or how this occurs, or why this occurs rather, based on the structure of the contract, we're going to talk about how you could protect your USD value when you are on the contract and when you are exposed. Then we're going to talk about some of the order types, okay. I hope that for the most part everyone is familiar with what a limit order is, what a market order is, what these imply in regards to taking or providing liquidity. We're going to talk about, though, certain order types, whether they are fill or kill, reduce only, and conditionals, and why these are important to understand. And then lastly, position sizing. So position sizing with leverage, all right, because again, leverage is useful to minimize your risk, all right. It is not something that you should just immediately try to increase your capital exposure with, because what you're doing is you are exposing yourself to, yes, the potential of more upside, but nevertheless, you still are exposed to the same. Downside. So it says that my volume is low, so I'm going to turn up my volume. Give me 1 sec. Let me turn that up. I'm going to ask if everyone can hear me again. 1 sec. Sorry about that, guys. Sound is good. Okay. Hoping everyone can hear me. Try turning your computer volume up too. So, all right. I'm going to get back to this. So, all right. So first, the uses of leverage, right? So in crypto in particular, leverage is useful because it mitigates for counterparty risk. So counterparty risk meaning that if you own a Bitcoin, you don't have to expose all of your Bitcoin to the exchange. What you can do is essentially, if you own 1 Bitcoin, you can place a tenth of that Bitcoin on the leverage exchange, use 10 times leverage, and basically expose yourself to the full size of a Bitcoin. So, one of the problems with crypto, one of the things crypto has been notorious for, was the exchange hacks. You've heard plenty of these stories. So counterparty risk is the risk that you expose yourself to when you get into a financial transaction with one other person. In this case, with the exchange. All right. So we mitigate for counterparty risk. We protect ourselves against this potential occurring. And one of the key aspects, or one of the draws to cryptocurrency to begin with, was the fact that there was that sovereignty, there was that freedom when it came to controlling your own wealth. So yes, that is one of the more constructive, correct ways to use leverage. We understand, though, that most people are using leverage to maximize their gains. All right, so this would be something that would fall under the category of greater capital exposure. So this platform that we're currently looking at is offering not a traditional futures contract. It's not a contract where there is a settlement, okay, or an expiration. It is a perpetual contract. So a traditional futures contract, all right, at settlement, or at expiration rather, it needs to settle with the underlying spot price, okay? So whether or not a futures contract, okay, is above the spot price or below the spot price up into expiration, all right, that'll depend on whether or not the market is in contango or backwardation, whether or not the futures are trading at a premium or a discount to the spot. So when the spot price is above the futures price, that's considered a positive basis. When it's below the futures price, that's considered a negative basis. Now, being that there's a good amount of leverage employed on these types of exchanges, okay, you can imagine that it's similar to more gunpowder with each one of these moves. So it's very likely, more often than not, that price can essentially be swung too far from the underlying spot price, right? And these need to be in tandem constantly. So think about this as an ongoing settlement across the board. So in order to keep this settlement, or rather these prices in line, the derivatives contract and the spot price, these exchanges incorporate something that is, it's considered a funding rate. It's a mechanism to keep the prices in line. And essentially, when the dominant position, okay, is, for example, you have a ton of people opening up leverage longs aggressively. All right, the dominant trade in any bull market is probably long. Okay, what happens is on these peer-to-peer exchanges, the longs will be paying the shorts. Okay, so the longs essentially are going to be paying interest to keep their position open. Okay, shorts that are currently not open, that are on the sidelines potentially, might be interested in opening up positions against the price at this point because they're getting paid to do so. So think about it like an incentive mechanism to move the derivatives price back to the underlying spot price. So there are many times when your position, all right, while it be fading the overall market trend, the funding rate can be in your favor to open up a position to take advantage of that interest that the other side is paying. Right? So it's a futures exchange, it's peer-to-peer, and it is a zero-sum game. So every long, there's a short. So the funding rate is something you need to pay attention to when you're on these exchanges, because although it's in a perpetual swap and there's no expiration or settlement, you can hold these as long as you want, all right? But what happens is you're essentially, there's similar to an options, that theta or that time decay. If you are on the wrong side of that interest rate or that funding rate, you're ending up paying off of the notional value of your contracts. So what happens is, say you have a large position open and the funding rate is very high, it's actually eating into your position. So this is something that you have to consider. All right. So the perpetual swaps are great for hedging. Okay, they're great for short-term trading. All right, but for the reason of rather on the basis that the funding rate gets very high often, okay, or at times during extremes, this is something that needs to be monitored and constantly considered. So what do we have here? We have the basic setup of the exchange. All right, the funding rate is always going to be listed, all right, down here. So the predicted rate will show, it'll show you when it's expiring, and more often than not when it's very high, whether it's a very high value or very low value, okay, volatility can kick up right before it expires as people try to close out the positions in anticipation, all right, rather than paying it. So that's another thing. So this shows us the current funding rate is negative, okay, and the mark price. Two things also that are important to look at, okay, because there are times when these are spread far apart, and what that means is there is an actual basis between the spot price and the derivatives price. Okay, so sometimes this can indicate a potential top or bottom. Okay, especially during periods of heightened volatility after the market has swung either to an extreme upward or an extreme downward. What we'll see is there'll be a large difference between the index price and the actual trade price. Okay, or the index price rather, and the actual derivatives price. All right, and this is just something to pay attention to as well. And if you're a BlockRoots member, we've talked about this before, about when there are extreme cases and how that is an indication of potential positioning by market participants. So, then we have the contract details. You have your basic setup right here, okay, your limit order, right? So we place a limit, we guarantee price, we don't guarantee execution. Okay, we have the market order, guarantees execution, doesn't guarantee price. So again, when you're exercising a limit order, you are putting on the book, right? So you're putting an order on the book. So if you're placing an order to sell, okay, you're going to be exposed up here in the offer, okay? It'll be one of the resting orders. If it's a limit order to buy, it'll be below the current market price and it'll be in the bid, okay? So you'll get prioritized based on when you put your order in. Guys, if you have any questions right now, remember I'm going to get to the end of them. I'm going to get to the questions at the end. So this is the order book, okay? This showing us all the available limit orders currently. So orders to sell, okay, offers to sell rather. So consider the bid and the ask, okay? All the offers to buy, so a bunch of bids, right? So at any time, you'll see this fluctuate, right? So during periods of increased volatility, right, this will suddenly fill in, this will suddenly, it'll decrease, and this is just what is available currently relative to the current price, right? I wouldn't say this gives really actionable information. Okay, under here, recent trades. So this shows us what actually executed. And, you know, I don't want to get into any heavy TA or the idea of reading the tape, but again, we talk about this in BlockRoots. But these are two important things to pay attention to, because at any time, if you're going to use a market order, all right, this is the liquidity that is provided to you relative to the current price. So if your order, okay, exceeds what is available within the first offer or the first bid, that is when you're going to incur slippage. So using a market order, that means that you are taking liquidity. So you're going to be paying, one, for the slippage, okay, especially during increases in volatility, and two, for the execution. Limit order, we place a limit order in the book. You know, current price is 9,679. We place a limit order at 9,600. All right, and what we'll see is that the order will be placed. Okay, so we want to buy long. All right, we're already at 25 leverage. I only have a tenth of a Bitcoin on this test net. All right, so what happens is the order is going to be placed. It's placed on the book, and then, oh, this is on fill or kill, so we got to get into that. So we'll place the order again. Okay, confirmed. It's on the book, and what you see is the actual order is listed right here. Okay, so the order is going to be in the book, but right now it's going to be all the way down the book because we are currently well above that price. All right, based on the increment level that we're looking at. We could change the depth, go by 1. It'll decrease the depth and make it a little bit closer. So what we have, all right, is the limit order, okay, the market order. I'm not going to make it 100 times leverage. And then we have conditional orders. All right, so synthetic USD, I want to get into that, okay. The other margin video and Bybit video we put out went into specifically how to exercise or use these orders. All right, so synthetic USD, that's what everyone is concerned with. And, you know, what that is essentially is it is allowing us to protect the USD value of the capital we have on the exchange. So when you put money on the exchange, okay, when you expose your Bitcoin to this exchange, although you are not currently long the derivative, remember that you are currently long Bitcoin, okay, from a spot perspective. So you are exposed to any type of movement within the market. So in order to protect ourselves against this, if we're trying to do what we would do on a spot exchange, which would be essentially to sell into USD, what you do is you go into, you could do this market, you could do this limit. So in this case, we'll do it market. We're going to sell 100% at 1 times leverage. So all of the capital that we have available, okay, at 1 times leverage. So 1 times leverage, selling short 100% of the capital that we have. And what happens is when we sell that short, it's going to show you a liquidation value that is just under $1 million, okay? You are not going to get liquidated. What happens is it's going to lock you into your position for USD value. So as the price of Bitcoin goes up, you're going to lose in BTC, but your USD is going to increase exponentially. So this is going to balance itself out. So this goes into how the inverse perpetual swaps are essentially constructed, right? So if you're a long BTC, you're short the dollar. If you're short BTC, you're long the dollar. Just think about it on those terms. So this is how we protect our money. So what we do is we go into, in this case, a market order, okay, 1 times leverage and 100 times capital that we have, right? So 100 times our balance. All right, not 100 times, but 100%. So 100%, okay, that is taking all of the available capital that we have in our margin. All right, the entire capital right now is being shorted at 1 times leverage, okay? And what you'll see is that it'll lose in BTC, but your USD value will remain the same. If you wish to get out of this, all you can do, or rather what you can do is you can either get out by a limit or get out by a market execution. So we're just gonna confirm all, close out this position, and right now, again, we are exposed to the market price of Bitcoin. So we are back into Bitcoin. So this is how you get into synthetic USD. Okay, so now I wanna talk about some of the specific order types, okay, that are currently available. Right, so we have time and force order types, all right, and then we have conditional order types, all right. Now, again, brief touch on the limit order. When you place the limit order, it gets put on the books, okay. This is if we are looking for price to come back to an area, or if we're looking to sell at a specific area if we are currently in a position. So if we are looking for, say, for price to come down to $9,000, again, we're looking to buy this retest of this area within the structure. What we would do is put an order at $9,000. And another thing that's great about Bybit is when we go to place this limit order, so right now we'll place a limit order, $9,000. We're going to buy long. Okay, none of these boxes are checked. Buy long. All right, I have to resubmit it based on the size. Okay, it's good till canceled, so this will stay open until I cancel it. The great thing is this box that pops up. So immediately Bybit allows you to place a stop loss order, okay, place a take profit order right away. So one of the best things, okay, is to or rather, one of the best things you could do is organize everything. All right, so there's not a multiple step process to you just executing a trade, or rather just placing a trade. So all of these things will have a, when it comes to headspace and when it comes to the bandwidth of your brain, okay, put it that way. The fact that you do not have to go from one place to the next just to place your stop, okay, place your target order. The fact that you can do this all in one, all right, we know that everything that's more convenient is in the form of something that's offering things in all-in-one. What is your phone essentially? It's an all-in-one tool. So we're able to place our take profit, okay, we're able to place our stop loss, and we're able to see all of the details regarding our trade. All right, most importantly, we're able to see the liquidation price of our trade. Now remember, when you are on the derivatives platform, you are not trading the spot price of BTC, okay? It's based on the spot price, all right? But you are not trading spot BTC. So if you're 1 times long, okay, you still have a liquidation price, all right? Liquidation price is essentially, it's about half the price of the current value of BTC, okay? So you need to keep this in mind, right? You will be liquidated in a long if you are using a 1 times leverage long on the derivatives platform, okay? So as you imagine, you're posting margin for the trade, the margin amount you are losing in value if Bitcoin goes down by half its value, and you are also losing Bitcoin's value as it travels downward and halves in value. So this is why your position is order submission error, price must have moved. Okay, so let's do this again. Let's do it on 2 times leverage. Okay, there we go. We'll do it 75% of our capital, buy long. All right, stop loss order. Okay, we'll say that our stop will be 5% away from that. Okay, and then confirm. And now the order is placed. So it's a limit order on the book. Once the order is triggered, all right, the stop loss will be placed. Okay, so this is important. Okay, so anytime an order is placed on this platform, unless you have reduce only, okay, chosen. All right, so I'm going to get to this, why this is important when it comes to take profits and stops. If you don't have the reduce only on, the orders are going to stay on the books, and while you might be stopped out of a position with a stop loss, your take profit will act as a buy, okay? Or in the case will act as a short because it'll be another sell order. So we're going to get to reduce only and why that's an important feature on here. So it's really important that you understand the features on this platform, okay, and how you could best use them to your benefit. So that's how to place a limit order. We could simply move this order if we wish. You could drag this order upward and downward, okay, and it's going to readjust that and place your order at the new price. Okay, so we're going to exit this order. Okay, market order, it's immediately going to be put on. What we can do is the same thing, place the market order, okay, it's going to show us all the details, our liquidation price. All right, we can put a take profit at this point, so let's put a take profit 100% away. Let's put a stop loss 5% away. Okay, and what this is going to be, it's going to be 100% away, all right, immediately. It's going to calculate the price for us, and this is going to calculate 5% away. You're not going to have to, this allows you to choose these right away. I would still manually enter in. I would get in the habit of manually entering things in so you don't make any click mistakes. All right, so now we're going to confirm. We're going to be entered in a long at market now. So, that's a conditional order. Let's pay attention. Okay, ready? So let's do this again. We're buying long. Okay, we're already in. Never mind. I did have it correct. So actually, let's just go from here. So the conditional order that is still on, okay, is a take profit. All right, so take profit is still on. I'm going to go ahead and cancel that. At any point, all right, this will lead us into the next point. Actually, this is a decent segue. Any point in any of these open positions down here, what we can do is come down to our position and edit the stop loss and the take profit. So click this little pencil right here. I'm going to get into the conditional in a second. And then you could add your take profit. So again, we'll do 100%. All right. And then stop loss 5%, confirm. And what it's going to do, it's now going to place these orders on, and these are conditional orders. And what you can see is now the conditional stop order is placed where I wanted the stop to be. And when price moves down through here, it's going to be a market trigger. So this is going to be immediately executed at the best available price. And this is exactly how I would say for you to use stop orders, okay, especially on a futures platform or a derivatives platform in this case, to make sure that no matter what, even at the cost of slippage, that you're taken out of a position. The last thing you want to be done, that you want to occur rather, is for you to be dragged under with a position and not properly taken out of it. So just to drill home, market orders guarantee execution, not price. Limit orders guarantee price, but not execution. So we're going to go ahead and cancel this stop. Okay, we're going to go ahead and close out our order. Okay, so we're going to take ourselves out of the order. In this case, I'm just going to market sell. All right, so confirm. All right, now we are out of this position. All of it, I could close out a quarter of it, a third, a half. All right, Bybit makes all of these things extremely convenient. Okay, extremely easy to use, great interface. All right, so now we're going to be talking about, before I get into conditional order types, something that's important for you to understand, and that is the reduce only. Okay, so reduce only. All right, so if we put on an order right now to buy long, so we buy long at, let's just buy long at current price. All right, in this case, reduce only is always put on for a market order, just so you know, but reduce only for a limit. So say we put on a reduce only order, okay, we don't have this checked rather, so we don't have reduce only checked. All right, we're gonna just arbitrarily place an order here, buy long, in this case, stop order, okay, take profit, let's say it's 50%, okay, stop loss, 5%. Okay, so we're gonna place this order, and now currently we are not in, all right, so it's a limit order. So when this order fills, okay, you can see it just filled. All right, so the order was just filled. Okay, so we are currently in, and we have a stop order, all right, but if we're stopped out of the position, okay, if we are stopped out of the position right now, all right, that position is closed out. Okay, so the stop will be executed, we will be closed out of that position, but we will still have a take profit on the book. Okay, so what happens is, if we're stopped out of the position, okay, and we walk away from this, from the computer, we walk away from this position, or we log out, we still have an order to sell above where we currently are. Okay, so if we don't have the reduce only box checked, that order will activate as a short if price comes up to it. So it's important that if you're going to putting a stop loss and a take profit for a specific trade, and for the function of closing out the trade completely, all right, so the take profit, the stop loss, and the trade execution grouped into one, you have to have reduce only. All right, so this makes sure that it cannot increase your order value, it can only decrease. All right, so your take profit that is left on the books, okay, will be nullified, and at that point you won't have to be worried about, you won't have to worry about being entered into any shorts without intending on being in those positions. So this is something that you really have to understand thoroughly. Okay, so now let's get into conditionals. So conditional, think about it like a trigger, right? That's what it's called, trigger orders. So we are currently, we have to close these positions out, so I'm going to close out of this position, okay, close that, take that stop loss off, again, as easy as just clicking the buttons, okay? I'm going to close out these conditional take profit, okay? I'm going to close out this market order, all right, I'm going to sell it at market. So conditional order types, okay? We want certain conditions to be met before we enter in. So say price is moving really tightly within a range, okay? So say we are currently back here, all right? For the sake of this experiment, we're back here right now. We are uncertain of what direction price is going to resolve in, but we are confident rather that when price finally chooses a direction, that it's going to be impulsive. It's going to leave behind the current area by some distance. Okay, so we want to take advantage of any type of breakout. All right, so especially useful when we have decreased volatility, when we have all things pointing to a compression in price action, a compression in volatility. All right, so whether you use ATR, whether you use Bollinger Bands, all right, whether you use decreasing volume with these, okay, whatever method you want to use, think about this as if you're waiting to, if you're an options trader and you're trying to take advantage of earnings, whether or not you're going to use a straddle or a strangle, okay, think about this as strangling the current price action. So a lot of the times you could see from a structural standpoint where the highs and lows of a range are. So what you can do with a conditional order is you can say, I only want to buy above a certain area. So what you'll do is, say we're down here, okay, price is currently compressing within this range, and we are looking to buy a breakout. We don't want to buy a fake out, we want to buy a breakout, so we're going to price the conservative amount of room, all right, that we would assume would be necessary for a breakout and not just a fake out, and let's say it would be 7,536. What we would do is put that as our trigger price, and then whether we wanted that trigger to cause a market order or a limit order would be up to us, okay? Depending on market conditions, For a breakout, you more often than not have to enter in at market. So let's use this as an example. We're looking at this recent high. Okay, if we think about the idea of an all-time high breaking, that's one of the highest expectancy trades. All right, so imagine this is Bitcoin right now on the 3-year chart. Okay, I know it isn't, but just for the experiment's sake. So this is the all-time high. Okay, or whether we look at Bitcoin on the daily or on the weekly rather. Okay, so we're looking at Bitcoin on the weekly, and it's only been on Bybit for so long, so that's actually not a good example. Let's just go back down to the 30-minute. So we're on the 30-minute chart. All right, we're looking to buy a breakout of this area right here. We don't want to buy the fake out. We want to give price a good amount of buffer. All right, in that we would, taking it's a risk to take, but we assume that if it breaks this level, all right, with volume, and it gets to this point, it's going to continue upward, such and such distance. So let's say that level for this experiment's sake is 10,250. So 10,250, we want that order area to trigger. All right, we're going to use market, so it's going to make this disappear. And at this point, we'll buy 50%, okay, at 2 times margin. And we're going to enter in a long at that area. So this is just going to show us again, okay, with these, you cannot put a stop on, you cannot put a take profit on right away. You have to enter in them after, or you can balance yourself out by placing a trade in the opposite direction. So we'll confirm, and now what you'll see is there's a conditional market trigger at that price. So if price touches this, it's immediately going to execute in market buy. So this is particularly useful for more advanced traders who are looking to take advantage of a breakout, okay, from the perspective of a compression in volatility to an expansion in volatility. Think back at beginning of 2019 when Bitcoin was moving up, okay, approaching that breakout that we all know as the beginning of the bull market. All right, that was an extreme compression in volatility, extreme compression in something like the average true range, okay, daily price action. It looked like, it was either going to snap down or snap up really hard. We weren't certain about what direction it was going to travel, so what we could have done is essentially straddled or bracketed that price action with an order to buy and an order to sell. All right, so if you imagine that, the same thing occurred right here, let's place that conditional, moving it down to 10,057, and then let's try to take advantage of maybe the opposite move. In case that happens, if we get a breakdown below 9,250. So in this case, same thing, same quantity, 2 times leverage. Okay, I want to sell short at market if we execute, or rather if we travel past that level. So 9,250. All right, what you're going to see is that it brackets the current price action. And this is, this is your strangle, right? So except that, in the case of, these futures contracts, you're not going to be paying the premium initially to open this position. So that's how to use this if you're one of the more advanced traders. All right? I wouldn't say to go about trying to bracket every area where you are agnostic about price direction, okay, but you want to take advantage of volatility to your actual open order. So if we are going to be placing an order to buy and then we want to place an order to sell under it, all right, so in the case of us wanting to buy the breakout here and place our stop here, you can imagine that that's exactly what we would do. All right, if we expect that price is going to move upward, what we would do is place a, say we put a limit on or a market order on, we're in, we want to place a stop. In that case, your conditional is going to be your stop loss. So whether or not you want to be a market stop or a limit stop, you have to choose based on this setting right here. But again, that's where you're going to use your stop loss. Or you're going to, that's how you're going to place your stop loss rather. So another thing that I don't see, all right, anyone talking about is some of the time and forces. All right, so time and force. Okay, so we have good till canceled. All right, essentially this is in an order that's just going to be left indefinitely on the books. So if we're looking to take advantage of a price that is ranging over a long period of time, okay, say it's moving against its monthly open, it's coming back to it a few times, we're trying to get filled each time it comes back. Maybe you place a good till cancel order, limit to buy at the monthly open, and you just leave it open, you walk away, and you're trying to get filled over a period of time. The order's not going to close out though, you'll have to manually close that out. Okay, immediate or cancel orders, when we place a limit order with immediate or cancel, what that's going to do is for the order that can be filled, okay, at the limit price, it'll fill. If it cannot be filled anymore, it's going to cancel the remainder of the order. So think about it as a good till cancel order, but if we're not filled at the best price, all right, based on the price that we set, the remaining portion of the order is not left on to fill over time. If it's not filled, it's canceled. the last thing, okay, which I think is useful, and it's particularly useful to scalpers, okay, is fill or kill. So with a fill or kill, if you cannot get filled at a limit price or better, okay, your order is immediately terminated. So it's either you're filled completely, okay, so if you have a specific size in mind, that you're a specific amount of contracts in mind that you're trying to put on, okay, unless you could get filled for exactly or precisely this amount, okay, at that price or better, the order is either rejected or it goes through. If it's successful, if it's available based on the current levels of liquidity, then it's executed all at once. Okay, this is an excellent way to scalp. All right, this is an excellent way to make sure that you get in. If you're a day trader, for example, and you're trying to get in on the lower time frame with a specific size, okay, you either want to get in at that price completely or you don't want to at all. Okay, you'll use a fill or kill. So I'll show you how that works right now. So let's go on to the 3-minute chart. Okay, so let's do a market order. Okay, we'll do fill or kill. Okay, let's say 25% at, in this case, 3 times leverage. And I'm just doing this at 3 times leverage right now and 2 times leverage, not because I think that you should be executing with that amount of leverage, but because I'm actually not doing the math right now and I'm not figuring out based on the test net how much available margin for each individual trade. So this is just pure laziness. But nevertheless, moving along. So we're going to do a fill or kill order. Okay, and for this price, we're going to say that we want it to be at, let's see, the current market price is at 9,736. So 9,000, let's say 9,740. We want to get filled for anything better than that. Okay, 9,740, right within that area. Okay, so let's buy long at limit though. Okay, and let's see if we could get filled. No take profit put on, no stop loss put on. Okay, and all of them were bought. So we were able to get filled based on what was available for that quantity immediately, all at once. Okay, let's do an example where we are looking to get filled for a certain quantity, but that price is not available. Okay, so let's place an order for 9,729. Pretty precise. Or rather, 9,725. Pretty precise. Okay, limit order though. All right, let's see if we can get filled immediately based on the movement of the market. Okay, execute. Okay, the order is submitted, but it's not filled. It was immediately canceled. So what you'll see is that, go to order history. Okay, that order right now was a limit order placed, but it was immediately canceled because it could not be filled for the quantity, all right, that I set it for. All right, so if you're trading the 5-minute chart, if you're trading the 1-minute chart, and you want to be trading with certain lot sizes or certain percentages of your capital, and you want to consistently use these percentages or lot sizes, okay, and you're specifically trying to get a good in at a good price, all right, or at a specific price rather, relative to where you currently are, this makes sure that you either get that or you don't. If you're not getting it all the way you want, it's have it your way or have it no other way. Okay, you either want to get in. This is essentially, you're negotiating and you're saying, I only want this price for this amount. If it cannot occur, I don't want anything. I'm walking away. So that is the fill or kill. Okay, and that is how it is useful for scalpers. So the last thing I want to talk about, okay, and this is the most important thing, least entertaining thing, is position sizing. So let's talk about position size. Okay, so most traders, okay, smart traders, I will say, will execute anywhere from, I'm going to set the upper bounds of 2%. Okay, so limiting their risk per trade to 2%. Okay, now for the most part, what you're going to find is that this means 2% of their overall trading capital, okay, or their total capital, all right, is going to be exposed per trade. Okay, so they're willing to lose 2% of their trading capital max. Okay, I will operate anywhere from a quarter of a percentage, okay, so 25 basis points, up to 1%, sometimes 2%. But for the most part, I am under 1%. All right, and that's what's allowed me to do this successfully, trading for so long, all right, especially trading on my own now, in that I have been able to do this, all right, and see the proper amount of trades in my system, okay, and not lose a chunk of my system. What I'm saying very in a more elaborate way than necessary is that If you position size incorrectly, you're going to blow your system up really fast. If you position size properly and conservatively, you'll be able to take advantage of, you'll be able to experiment with systems and see, okay, I had a run of trades that did not work out and I didn't lose too much off the top of my head trying that out. All right. But you have to think about it as ammunition, right? So are you either going to spend all of your ammunition or rather all of your energy with just a few shots with a cannon, okay? Or would you rather have 1 million bullets, all right? So when it comes to position sizing, so say for example, we want to, we're willing to risk 1% of our account per trade, okay? Now, in a perfect world, our stop would be 1%, or in this case, it would be less than 1% away. All right, so that would be great if we are willing to risk 1% of our account, all right, for each trade, and the stop is the proper stop is less than a percentage away. That would be great, but that doesn't happen, right? So more often than not, certain trading conditions, okay, and BlockRoots members are familiar with this. We have a whole roadmap on it. Trading conditions are going to dictate what type of stop and approach that you are going to implement. So in a trending market, you need room to breathe. All right, if you're taking advantage of a higher time frame trend, your stop is going to be based on maybe volatility. So it might be a multiple of volatility, 2 times volatility, 3 times volatility. You see this in traditional markets. It's used with CTAs. I've used it before. This is for larger position trades. Okay, you need to give price breathing room. It'll be based on volatility or ATR. So you typically 1.5, 2.5 ATR. Depends on if you're conservative or if you're a little bit more risky. So if you're in certain other market conditions, where price action is really compressed, all right, based on certain market structure, you might be looking to put on a tighter stop, okay, because you either want to be in on the right end of things or, okay, you want to be out right away, all right, because if you are in, all right, and price moves against you, right, you don't want to be the first to go to the bottom of the ocean, all right, when everyone else is piling on top of you. So certain times you're going to be using those tight stops, okay, and that might fall within your overall risk limits, might fit your system, but you're not going to find that, right? You're not going to approach the market, shake it like it's a money tree, take money anytime you want, and have the perfect conditions. So a lot of the times what you're going to do is you're going to see, okay, I might not be able to get optimal entry based on where my stop is, all right, but I need to be in, let's say we're taking advantage of a breakout, for example, okay, so maybe my stop distance is, maybe it is 2 times away, all right, 2 times my initial risk. So you could think about it in terms of R, okay, think about it in terms of R multiple, all right, you could think about it in terms of percentage though. So to keep it simple, I like to think about it in terms of percentage, all right. If we have a initial risk, all right, so let's say that our trading capital is, we're willing to risk, okay, in the event that your stop is further out than your risk. So account risk is at 1%, okay. And let's say for this trade, the stop at, I don't know why I used at for the symbol and then at written out. That seems kind of moronic. Let's say in this case of the trade, needs a little bit of breathing room, stop is 3% away. All right, so now what we're going to do in this case is we are going to actually divide our risk, okay, by the stop distance. So as you can imagine, 1 divided by 3, it's going to be basically a third. All right, so 1 divided, that's obvious, it's going to be 33%, okay? So in this case, okay, it's going to be 0.33. What we're going to do is we're going to multiply that by our account value, okay? So we're willing to risk 1% of our account, but the trade doesn't work out such that the stop fits within that properly, because the stop needs more room to breathe. We need to position size accordingly so that if we are stopped out in a 3% move, okay, that goes adversely against us, all right, in that case, it still fits within our system. So let's say that we have a $100,000 account, okay. Not everyone has a $100,000 account. Let's say that we have a $10,000 account, okay. We open up a $10,000 account, all right. The trade stop is 3% away. The account risk is 1% away. So, with the overall account risk being 1% of $10,000, each risk, we're allowing ourselves rather $100, all right, in terms of loss, okay, what we're willing to risk. Okay, so in this case, we have to position size properly for that. So it wouldn't be the full account value. The position size, okay, would equal, all right, the percentage, so it would equal the account risk, all right, divided by, okay, the stop distance, all right, multiplied, okay, by that account value. So multiplied by the account value. All right, so in this case, it comes out to be $3,300. All right, so we're willing to risk, all right, in this case, $3,300 towards the position. Okay, so this allows us to fall within that limit. Now, this is something you can do on a spot exchange, right? So in this case, you really don't need any leverage. You can use leverage, as I said, though, to minimize your risk, minimize your exposure. Okay, you could position size such that you are only using, based on the amount of margin you're posting, all right, you're only using a very small amount of Bitcoin to represent this risk, right? So you can have your initial risk for a trade be $100, and it doesn't have to be that your stop gets hit, but the entire trade represents that, and you could use leverage to actually position size so that if the trade gets wiped out completely, okay, without a stop, that represents your risk. I wouldn't go about practicing this. It's not something that I want to get too heavily into right now. It's not how I would say. Some traders will use their liquidation as a stop. I wouldn't get into that. It's just not properly learning risk management in the beginning. So what about in the case where our stop is closer than our account risk, permissible level? All right, so let's say in this case, we're willing to risk normally 3% of our account. So we're not as conservative, okay? It wouldn't be abnormal, all right? While it's not something that I practice. It is something that, I know traders who their system incorporates 5%. Okay, so let's talk about a trader whose system incorporates 5%. So they're willing to risk 5% of their account value per trade. Okay, and let's say that in this case, they are trying to take advantage of a stop where they're trying to take advantage of a breakout trade. All right, they have a decent entry, and based on market structure, okay, based on market conditions, the stop is actually, it's only 1% away. So stop distance, okay, and account risk, yeah, okay, their stop distance, okay, their account risk, okay, is 1%, okay. So in this case, all right, we'll go to the calculator, okay, 1 divided by 5, okay, so we're going to take that value. Now we could multiply it, all right, by our total capital. So in this case, 5 times 10,000, you can imagine it's $50,000. So what we can do in this case is use a 5 times leverage. Okay, so this equals 5. So equals 5. All right, so we could use 5 times leverage and still maintain the initial risk allowed by our system, right? Because in this case, even though we have a larger position, all right, the stop that we're using to get out of the trade, all right, falls within, not only within, but it gives us way more room, all right, such that when we are stopped out, okay, it falls below what is considered, let's just say it's our normal threshold of risk, all right, and in that case, we could actually employ more leverage. And like I said, all right, this is something that's going to be dependent on market conditions. So I know who I'm talking to. I know that I'm talking to immediately traders who want to up their stack and who are going to be using leverage in I would say with less discretion. All right, so I think it's really important that you understand how to do things properly first, though, because the numbers are so against you in trading. Okay, the attrition rate is such that most people fail for the same reason. Okay, but most people, even knowing that reason, most people that are completely aware and told all of the cliches, will continue on and will, just continue to walk towards their demise in that case. So this is how to properly position size. All right, you've seen this before. Okay, when it comes to your initial risk, all right, and your account value and your stop distance, and how these are incorporated, or rather how these function to dictate what your position size is. So that pretty much covers the lesson on leverage and margin. Okay, at this time I'm going to go through some of the questions. If I missed anything, feel free to ask me. Again, so we have a video on perpetual swaps, or in this case, inverse futures contracts, all right, or how the swaps work, how they're we go into more detail in regards to the funding, okay, how the contracts are constructed, and some of the other idiosyncrasies. But hopefully that covered pretty much everything that I set out to cover. If anyone has any questions, all right, remember to write them. I'm going to go through some of them right now. I apologize for the sound earlier on. I hope that it improved. So let's see. We have, okay, hey there. Let me just, you know what I'll do? I'll pull the YouTube over to this channel. Well, actually, here we go. Excuse me 1 second, guys. If I could just get this, there we go. All right, so not showing video, good. Hey there, all good. Okay, Ken M here. How are you? Bitcoin about to pop again. All right, so first question, do something about the volume. Okay, I'm just gonna read through these and see if I do these in one. Okay. How can I switch? Okay. All right, so Bitcoin about to pop. All right, let's look at current setup. Now, don't get me wrong, this is extremely bullish, all right? Heavy rejection, this is something you have to keep in mind though. People are talking about, you have either people that are you know, willing to recognize the fact that this is entirely bullish, or you have people that are talking about that this was such a rejection. I think you have to take it with respect to the previous point that this is extremely bullish. You know, we had a move that we've never had before, and or at least I think the figure is that we had never had a move of this magnitude in this short amount of time. And that is the one thing that is so great about Bitcoin. It's highly reflexive. I've said this before. Heavy rejection, but right now we're marching into that wick. So we still are at this resistance. Okay, by all means, I'm not. You know, I'm more conservative when it comes to my approach. So I'm looking at this point to buy dips. And this is not exactly the dip that I am looking for. This is not something that really looks like a dip to me at all. Okay, price is still looking strong. I do want to see us come down to, or rather see if we can come down to, let's like 8,800, 8,900. I would still be bullish if we came down and retest this structure down here at 8,600, 8,500. By all means, though, all signs to me point north. Now, it's important to keep time horizon or timeline in perspective though. More often than not, when you have a big move like this, it doesn't necessarily mean that there's going to be immediate follow through. Okay, although that is the first thing that everyone is looking for right now is for immediate continuation. It's not that I would really expect that. Okay, I expect to price move a little bit, you know, move sideways for a little bit. If we can get over, and I don't have my, let me open up. This is the BlockRoots community, by the way, guys. So we're talking about, this is the incredible community that we built. Ton of participation on there. Bear with me on the speed. All right, let's turn off the alpha trend. Come on, catch up, buddy. You can do it. You could do it. All right, so let's open. So right now, just on the Clark indicator, we can see that the monthly and weekly opens. All right, the monthly open is indicated by the red dots. Okay, weekly opens are indicated by the black dots. So we are right at the previous long right here, but this does look entirely bullish to me right now. If we had a 4-hour close, all right, below this structure right here, I would be a little bit more concerned, but right now I can't. It's hard for me to say that sentence because I'm not concerned. All right, after a move like that of that magnitude, I think that it's clear that this was the point in which the market took everyone and then ripped their face off. So I mentioned that in a video not too long ago about taking everybody to that point where everyone felt like it was just comfortable, sit back, put your short on, and sail off into the sunset and ride this thing to the ground. You had really poor sentiment. So I would just say that the sentiment got extremely negative really fast. And if we considered sentiment like we consider volatility, divergence between passive order flow and active order flow, it looked like the heavier short and then take advantage of their positioning and push price against them, right? So at that point, it's worth it if you're an aggressive trader to go. Here we go. Some of the questions. Okay. Sorry about the mic, guys. Am I long now? Yes, I am still in a long. I'm still in a long. I did not get a fill, so BlockRoots members know that I called for a little bit more of a pullback to add on some more. But now, yeah, I'm still long spot and long futures. Okay, is this a bull trap or are we going to the moon? I don't like to think in just diametric opposites or think in extremes. So this could very well just grind its way upward from here. Doesn't necessarily mean we are going to go to an all-time high anytime within the next month or two. Good time to short now or go long. Yes, I do have 3 monitors that I'm looking at, but I am taking my trackpad, which is new. I have a new type of trackpad, taking one screen, moving it to the other, because the only screen record is coming from this screen right here. So, cup and handle? No, it's a meme. Yeah, so that's a good question. Do you consider your account risk in terms of dollar value even when collateral is in BTC? Yes, I do, just as a form of habit from always considering account risk in form of dollars. And I am, like I said, long-term spot holding in Bitcoin. Enjoy accumulating more Bitcoin, primarily trading for what is commonly exchanged for your milk, eggs, and gasoline, which is USD. All right, so what to use just a stop limit orders, last price, market price, and okay. Oh, right, okay, so let's go. For the market orders, for the limit orders rather, or rather for limit order, excuse me, last traded price. Okay. More questions. Will we be back at 6K? That's possible, all right? So the problem with Bitcoin is that we only have so much of a sample size in terms of the chart history, okay? And what it causes is all of us to look to previous price action, previous behavior, and immediately it has to assume the same pattern as it did previously. Even though we see that Bitcoin, if I go to, let's go to just a Bitcoin, if we look at, I think I have the Bitstamp one here. So if we look at this chart, it does look like a chart that's growing, or rather an asset that's growing logarithmically. So there is it's rather easy to assume that this will occur just the way that it did in the past. Okay, based on certain levels of adoption, just general drift drift in general. As people accumulate more of this, okay, and trade less of it, as if there was some level at which this increased over time, as if that had a speed. So I don't get too heavily into on-chain metrics. I couldn't really talk about that. That's not my province. But you know, this could very well do something that it had not done before. And that means that it could take much longer. All right, it could do this in a much shorter fashion. Okay, it could have a heavier retrace during this cycle. All right. What I will say is that it was, you know, in the beginning there was much less liquidity. Okay, so some of these movements were likely. What we'll see as time progresses is that this will actually decrease in volatility as the price increases. So in the beginning, much more volatility, much less liquidity, okay, much more violent. All right, so if we are looking at this, we have to understand that this sample right here, okay, is under a different context, right? More people come into the space as the space becomes more liquid. We will see volatility actually decrease over time. And if Bitcoin gets to 2,000, we should see, you know, 2,000, excuse me. As Bitcoin continues to appreciate in price, we'll see that that volatility decrease. So if Bitcoin goes to 200,000, you can imagine the volatility levels are going to be much different than they are now. Okay, it will not be the trading days. Bitcoin trading days at that point will likely be behind us. Okay, swings will not be part of the day-to-day routine. So, what are the questions? Okay. Bybit is better for sure. No, just perpetual swaps, right? So if you're bullish on Bitcoin long term, I would say use one of the Quanto or traditional futures contracts, which are offered on other exchanges. But I would say for traders who are looking to take advantage of short-term fluctuations, okay, short-term, near-term, intermediate term, even long-term, use the swaps, right? So the inverse perpetual swaps. So Bybit is what I would hedge with, okay, if I was shorting, hedging by shorting, okay. Like I said, that you have to keep in mind what the current funding rate is. So you always have to keep this in mind because it does eat into your position. When it comes to the swaps, though, just as a matter of how the contract is constructed, if you're long, you need to constantly be rebalancing because if you're just long a position, since the margin is denominated in BTC, the contract is in that, your gains will be decreasing. They don't increase linearly. So actually, never mind. I'm not even going to get into this for the sake of this beginner's discussion. What alt am I interested in? Well, darn, it would have been really nice to get into Neo, right? To take advantage of what I think is an extension of the narrative. Not that suddenly there's a fundamental case for Neo. I think that it's just a matter of this market being so reflexive that everyone suddenly said, "Oh wait, Neo, that's Chinese, China, that's Chinese, right?" So I like to take advantage of short-term volatility in things that are liquid though, and that have a good amount of trading volume, right? So I like to take advantage of more than. Put it this way: I want to get into something that I could scale into a decent sized position in, and on some of the alts, they're you're only able to take advantage of them if you are trading with a smaller size. All right. I'm not one to put on a position in an alt that is, I would say, of any size because the likelihood that I have to incur the cost of the round trip is not worth it to me. All right, I'd rather trade something that I am way more familiar with. I've mentioned Andy Hall before, and him being one of the people that I've idolized in my trading career because he was married to oil. Okay, and I think that there is something to be said for mastering one asset. All right, an asset especially that is more heavily traded. Okay, more readily available and more liquid. Yes, of course there will be a replay, Ken. So does anyone have any other questions? Okay, about Bybit, okay, about BlockRoots, all right, any of the things we talked about in this video. Again, if you're not currently on Bybit, use our link below. It is definitely the most superior platform currently. I loved it when the other day BitMEX ran into issues, okay, Deribit ran into issues, all right, FTX. I don't want these people I don't want them to not succeed, but Bybit, 4 billion without a hitch. Okay, go with the tech. We are talking about something that is all about the progression of technology, okay, and the betterment of civilization, right? Whether you're in it for the money or for the technology, okay? So why not go with the exchange that has the best technology? Do you want a second-rate obsolete platform? No. Go with the exchange that has the tech, and that's Bybit, all right? Not only that, Ben is a tremendous guy, okay? He personally answers people's questions. If you have an issue, if you think that you have an idea that can make the exchange better, it seems like every request that people have had, they have immediately produced. So I think that's incredible, all right? If you're a small business and you're doing that for your customers, if you're a big business and you're doing that for your customers, that's huge. So being able to attend to customers' needs and what they want for the exchange, rather than imposing, their will on what they're willing to provide and not willing to move, okay? With the archaic architecture, all right, with a matching engine that is a dinosaur, all right? Forget about everything else. Bybit is the place to trade. And just as a function of interest, okay, the volumes, liquidity is only going to improve. And unless you're trading ridiculous size, you're not going to experience any pain trading on Bybit, no matter what other people tell you. Trust me. Trust me. All right. So who do we have now? Hey, Ryan. Hey, what's up, Banga? So Banga is one of the members of BlockRoots, and this guy has come a tremendous distance. All right, we're not going to boast. We're not going to talk about facts and figures, but this guy is becoming quite a trader. All right, I personally got to know him, and if you have any questions about his experience, all right, about his trading journey, feel free to message him. So let's see. Do they have a mobile app yet? So they have a mobile platform accessible by web. So currently, if you're on iTunes or if you're an Apple user or an Android user, I don't believe they have an app. But the mobile web-based browser looks like an app. It's extremely user-friendly. All right. So I think that that pretty much covers it. All right. We have another video that's on the same thing. We went over other features on Bybit as well. Just wanted to do this brush up. I think now is a great time with volumes picking up, okay, with the space growing. It's important that you are on the right side, okay? You're with the right tech, okay? You're with the right team. Don't put yourself in a position to not be being able to. No, we're not going to talk about that. That's over trading, buddy. So don't put yourself in a position where you are, okay, your intentions are correct, all right? Your directional bias is correct, but you cannot get into a trade and you cannot get out of a trade, all right? Don't put yourself in a position where you're part of an exchange where the exchange doors are shut, okay? Closed for business currently because we cannot handle the order flow, or rather the volume. So join Bybit, use the link below, okay? If you're not currently familiar with BlockRoots, all right, check us out. All right, we are a tremendous community. Okay, I guarantee you, you will not find you will not find what you'll find in BlockRoots in a trading group. Okay, with any other personality on Twitter. Okay, this is something Josh and I talked about for a long time before deciding to pour both of ourselves into. Okay, and I know I say okay a lot. I'm probably gonna get crap after this for that. I just parse my sentences with okay and all right more often than not. So if you're not familiar with it though, check it out. $50 a month and you get access to what I would say kind of blows away anything else. All right, the level of sophistication, we cover everything, but the level of sophistication of the stuff that we're getting into, especially as we bring everybody up to speed with the workshop, okay, with the intense workshop that we're going to be doing, not speaking in hyperbole at all. All right, we're going to go over things that are going to offer you, that have offered us and the members, the edge required to operate effectively and efficiently within this market. Okay, there's plenty to go around. There is absolutely plenty to go around. So let's see, before I close it out, how do you feel about the threat to U.S. citizens using Bybit? So let me just say this without saying anything explicitly. Every single trader on an exchange in crypto or trading cryptocurrency should be using a VPN. Hands down, no matter what, you should be using a VPN. Okay, that is how traders use BitMEX. Okay, that is how traders use Deribit. All right, you should be using a VPN no matter what. All right, I'm not familiar with any threats whatsoever. Okay, keyword threats or anything that I would say is incendiary at all to anyone who is using any exchange currently with a VPN. You can use any exchange with a VPN. All right, so just put it that way. Okay, let's see. All right. Hey, I'm happy that everyone used my my emojis. All right. BlockRoots, wink, wink. All right, guys. So it's been fun. You know, we like to do these live streams often. We don't often open up to the public though. So as always, guys, as I always say, exercise, proper risk management, trade effectively. Have a fantastic Sunday. It is 5 p.m. Eastern time in New York on a rainy Sunday, and I'm about to go outside, or rather, I'm about to, if you want a little insight into what I'm about to do with my day, my wife is horseback riding, and I am about to go to Best Buy and buy a really big TV because we are having a big Thanksgiving party on Thanksgiving, and I need a new TV in the living room. Not that I need one, but I'm kind of a tech junkie, so I want to go see what they have to offer. I want something we could throw the game on. United States, everyone is obsessed with football, but guess what? I don't care about football at all. I played football my entire life. I was a wrestler my entire life. Did a lot of combat sports. Don't care about watching football at all. Don't care about watching grown men slam their heads into each other. But other people do. So it's the status quo. So I need to have the football game on for the let's just say the elders. So the older men in the family are willing to sit down with a bunch of kids running around because our family is really big, and the football will probably keep their attention. So that's it, guys. Okay, it's been a pleasure. I look forward to interacting with all of you more in the future. Check us out at BlockRoots. Check me out at Kenner and Clark on Twitter. Check Josh out. I'm sure everyone knows who Josh is. He's an amazing guy within the space. I don't think I've run into a better person, honestly. I could genuinely say that. So that's all, guys. Have a fantastic evening, morning, wherever you are. Best of luck, as always. Signing out.